Welcome to our 15th annual Look Ahead conference. It's February 14th of 2022, and so I just want to say happy Valentine's Day to everyone out there. And we are going to try to get this recording up to everybody as soon as we can. My name is Russ Weigel. I'm Associate Investment Advisor with the Mindset Wealth team. And we have Rudy Chung over in Vancouver.
Good morning, everyone on the West Coast. Good afternoon for our listeners in the East Coast.
And of course, we've got Robert Mulrooney, Senior Investment Advisor here in Comox Valley with me.
Good morning, everyone. Happy Valentine's Day.
All right. Well, thank you very much for taking the time to watch our video. We like to do these look aheads every year around this time, and a lot has changed in 2022. We're seeing a lot more volatility. Even though it's Valentine's Day, we're not really feeling a lot of love from the markets. We are seeing some of the highest inflation that we've seen in decades, as well as there's geopolitical risks out there with Russia and Ukraine, and of course there's still COVID. COVID has not gone away yet. As much as we'd like to see it disappear, it's still sticking around. And so today we are very lucky to actually have a really fantastic speaker with us. We wanted to get somebody who could actually give us a real big top-down view of things and how that relates to the market. So we're very fortunate to have the Chief Economist of Industrial Alliance, Sebastian McMahon. He's also a senior portfolio manager and works on the diversified funds. He puts together some of the portfolios. And he's been with Industrial Alliance since 2013. He has over 20 years experience in the private and public sector. And he's also works on the asset allocation committee that puts together some of the portfolios that I runs. And he's got about a 10-minute presentation for us. So with that, I'd like to pass it over to Sebastian McMahon. Thank you very much for joining us.
Thank you, Russ. Thanks, Rudy. Thanks, Robert, for having me. So I will be sharing my screen here just because I brought few slides to try to make things even more simple. Let's say, because the economy can look complicated, but it's actually not so complicated when you know where to look. And where better to look than to start probably with a top-down view, a bird's eye view here of growth, so economic growth. So this is from the IMF, International Monetary Fund. They do forecasts for much all of the countries within the OECD, also emerging markets. And the picture is actually pretty strong here. If you look at the world output line, the orange line on top, 2022 growth expected to be at 4.4%. That's real. So that's the volume, the quantity of goods and services that are being produced. That's way above the long-term trend. So we're still in a very robust part of the business cycle. 2023 is expected to be at 3.8. So a bit of a slowdown, which is normal. And we're probably going to be tapering off all the way towards the long-term trend, which is between 3 and 3.5%. But 2 years of above trend growth, usually that means that we're still in the early parts of this business cycle. When you look at Canada here, interestingly, Canada is expected to outgrow the US in 2022 and 2023. So a few reasons for that. We think the Canadian economy is in a very good place, mostly because of its labor market. The reaction to COVID was a bit of a question mark when COVID happened. What do you do when you're the government? And it seems that in Canada and in Europe, we did a little bit better than in the US, in the sense that instead of just mostly sending checks to everyone to keep on consuming, they subsidized wages, subsidized rents to make sure that the jobs that were put on pause were there when the economy reopened again. Because as you remember, it's not the typical recession that we had. We shut the lights on the economy and now we're reopening them room by room. We're playing with the dimmer, but I mean, it was really a shutting down of the economy and then reopening it. So you needed to make sure that at least the jobs were going to be there when you turn the lights on again. So Canada, strong footing from its labor market. Exports are doing well too, because commodity prices are strong and what we export has raised in the value too. So Canadian economy on very, very strong footing, and that influences us in our strategy, because I'll be discussing exactly our views in the portfolios in a few minutes, but we like to remain overweight stocks tactically right now because of some volatility since the beginning of the year. The Ukraine situation since last week, we removed some risks. We're more now neutral in equities, but it's still within neutral equities. We're overweight Canada and we're underweight the US. So we'll discuss that more in a few seconds here. But we like Canadian equities. We like equities more than bonds. So in an environment like now with rates going higher, the economy is strong, inflation is strong, rates are moving higher, and central banks are looking to normalize monetary policy. We like to be underweight bonds in our portfolios. So just wanted to spoil that now so that as we move forward, have a better understanding of this. But if you look at GDP here, as I said, sitting on a solid foundation here, what I brought was the consensus survey from Bloomberg. So when you have access to a Bloomberg platform, you can just download this data and look at what the consensus of economists is thinking. So on the left, you have 2022. Red is Canada, blue is the US, gray is the Euro zone. So as you can see, pretty much all the same here. Bloomberg consensus has Canada underperforming the US a little bit in 2022. The IMF has it outperforming in 2022. But when the picture that's more interesting is the one on the right in 2023. Consensus is getting even more and more bullish on the Canadian economy. So we always have a long-term horizon to our investments, and we think Canada is the way to go. For a while, the TSX is cheap compared to its own historic, cheap compared to the US stock market. And in fact, it's as cheap as it's been since the peak of the dot-com bubble. If you look at the valuation gap between the TSX and the S&P 500. So we like to position ourselves in the TSX right now. Energy, value are all themes that do very well when you have a strong economic cycle on a strong basis. You have rising rates. You have a normalization of monetary policy. Usually you want to be more in value, more in commodities. And this is exactly what we offer here in Canada with the TSX. So again, one more reasons why we're bullish on Canadian equities. Inflation, the question is, are we at the peak? When you look at the chart on the left, it seems to be still going parabolic, but actually when you zoom in on this chart, because here it's since the 1950s, I wanted to give the total picture, but Canada in red, US in blue on the left. Actually, if you just do the arithmetics, we are expecting a peak in inflation. If it was not with the number that we just had last week in the US for January, and we'll have January inflation this week, actually, on Wednesday in Canada. That's not the peak, maybe next month should be the peak just because of simple arithmetics. And after that, we should taper off. And the consensus is for inflation to be at about 3% at the end of 2022. So the inflation, remember, that is the change in prices between the same month in different years. So we just had a comparison of January 2022 versus January 2021. And in 2021, at the beginning of the year, gasoline prices were pretty low. Car prices were pretty low, and they accelerated very massively in the first quarter. And after that, they started to grow at a softer pace. So that should bring the pace of inflation to slow down quite dramatically through the year, bringing us to about 3% at the end of the year. Now, the forecast for 2022 on the right, blue is the US, red is Canada again, the gray is the Eurozone. This is the average inflation for the year. So in Canada, the forecast is still about 3.5% for the year on average. So if you start at the beginning at 4.8 and the average is 3.5, that means at the end of the year, you need to be much below 3.5 for this to come to fruition. So the consensus is pretty clear that we will be seeing inflation slowing down. So slowing down by itself and also helped by central banks, which will be starting to hike rates. It always takes 12 to 18 months before monetary policy starts to have an impact on inflation, slow things down. But it's going to be an important story this year. How quickly, we're hearing many things. In the US, we're hearing regional Fed presidents wanting to go very quickly. We're hearing some others that want to go very slow and steady. So we'll see what they do. But in Canada, where we're based here, Mr. Maclean, the governor, says that inflation still is mostly about supply. So it's not, that means that the monetary policy, central bank can't solve everything. So probably a more gentle path is expected. So expect 3-4 hikes in 2022. So right now we're at 0.25% on the leading rate. At the end of the year, we should be at about 1.25. At the end of 2023, probably at 2.25. And then we'll see. We'll see when we're there, where that leads us. But the market is expecting that. So that's why you had interest rates going up so far this year, and that's why your bond portfolios probably have negative returns year to date after a few months. Bonds are there for a reason in a portfolio. It's to manage volatility. So it's not because after a month or two you have negative returns that you don't want bonds in your portfolio. They're there to stabilize the portfolio, and the higher the rates are getting, well, the more interesting will be the returns after that for bonds. So it's just a normalization process, but managers were paid to add value in portfolios. So that's why in our positioning, if I go to my final slide here, the current positionings on the left, the 12-month view is on the right. A few things changed just before we started recording this. We did remove some US equities in our portfolio. So the US equities line should be very much a red box. I didn't get a chance to change it here. So we're tactical when things happen. I mean, we act as the days move, but underweight bonds, since we think normalization of monetary policy is going to still be there, inflation is elevated, so maybe you don't want to have that as much bonds as would be the norm. Overweight equities, overweight especially in Canada. We like emerging markets a lot for 2022. Right now, we're starting to build an overweight, but we expect to build a larger overweight as we move through the year. We like value over growth, and we think the Canadian dollar, because of the Canadian story, makes a lot of sense to be seen as going up. So that means some hedging of the currency exposure within our portfolios. So that maybe I'll leave that slide there just for reference, but that's the message I wanted to share today. So maybe Russ, I can send it back over to you.
Thanks, Sebastian. I've got a question in regards to inflation. And we've seen inflation really move up over the last few years in particular. And I'm just wondering, how do you look at inflation and then take what you see and use that in terms of putting together portfolios?
The main part is what I mentioned, being underweight bonds, because inflation when it's very strong, it tends to push interest rates higher. But beyond that, we also did our own works. We studied history, and when you're in an inflationary environment, you have to be very active. So that's a key. So we're more active than we were. Usually, and this is still the case here with the price of gasoline and the price of oil, inflation is caused by commodity prices. So you want to be exposed to everything that is related to commodities. So if you can hold them outright, that's one thing. But here in diversified portfolios, being more exposed to the Canadian equity market makes a lot of sense because of the impact of commodities. Same thing with some emerging markets out there. So we like that. And within equities, I don't do stock picking, but our portfolio managers, what they've learned through time is that pricing power is key. So being exposed to the right sectors and the right names with pricing power, that's how you can add value. So there's many dimensions of being active, and we implement them all in all of our solutions.
Fabulous. Thank you very much. I'll pass over to Rudy now. I know Rudy Chung has a question.
Thanks very much, Sebastian. I'm very grateful to have someone like you on our team to give us a very good insight in a world where there's just so much noise, and a lot of good basic points for clients to take some points away with. My question is more focused on real estate. Being based in a town like Vancouver, real estate is the straw that stirs the drink for a lot of people. It's got huge impact on the local economy. I think for a lot of people, because so much of their net worth is tied up in real estate. My question would be, with expectations on interest rates, and what kind of impact can real estate investors expect in the current interest rate environment?
The Bank of Canada did many studies on that. The households, the Canadian households that are overly indebted, then the limit set by the Bank of Canada is 450% of your annual income in debt. So that's a higher ratio. Higher interest rates will hurt these households more than the others. So those are vulnerable. So central banks normalizing monetary policy. If, for example, you don't have a fixed rate mortgage, then you might have some issues servicing that debt. So those are vulnerable. The rest of the population, the picture is actually not too bad. Bank of Canada, what they did was they looked at the markets, and the mortgage market in Canada, it's about, on a regular basis, about 80% of new mortgages that are fixed and about 20% that are variable, and fixed for 5 years. So what they did, the smart thing to do is to look at vintages. So let's say everyone that subscribed for a mortgage in 2017 or at the end of 2017 will have to renegotiate their mortgage for the next 5 years at the end of 2022. So you look at what the rate was in late 2017, and actually it was a bit higher than it is right now. And if you have 4 hikes in 2022, at the end of the year is going to be similar to a little bit higher than it was in 2017. So the impact's going to be minor. After that, those in 2018, they had a rate that was also higher, 2019 higher. So at some point, probably those that had their mortgage in 2021, 2022, those are the ones that in 2026, 2027 might be facing higher rates and have some issues. But in the short run, the market is, the rates are still supportive of households being able to continue with their payments. If we look at just the price of houses, it's led more about demography and people moving to Canada, moving to Vancouver, moving to Toronto. I'm based in Quebec City, and the market is not really crazy because we don't have this expansion in the demography here. So it's going to be led again by supply and demand. So expect prices to continue on growing, but as long as the population growth is there, these markets should be resilient. But of course, we're now getting more and more sensitive to what central banks do with prices at the levels that you mentioned.
I guess I'll be the political guy in the room. May you live in uninteresting times. Holy cow, we have Russia, Ukraine. There's talks about China, Taiwan, certainly what China was doing earlier or later 2021 with the crackdown on tech. What's going on in the US, and certainly Canada is interesting nowadays as well. How much time at IA Financial do you spend on the political aspect of things?
Well, one thing we learned from the Trump election was to not trade too much on politics. I'm not a geopolitical expert, but I read a lot of geopolitical experts out there. So what we do know is the long-term strategy should not be influenced by what is going on in the political side and geopolitical side, but in the short term, you need to manage the risks that surround that. So the last few weeks, we were seeing Ukraine and Russia brewing. It wasn't really impacting the markets until last week, when finally it seemed that maybe it was imminent that something's going to happen. So we removed some risks from the portfolios, and we'll be looking to add those risks back when we think that the risk premium that's in the market has left. So we do that. But other than that, we don't spend an excessive amount of time on geopolitics. We'll just look at what's priced in, and do we think that the market is not pricing the right things. But generally, geopolitical issues, there's a risk premium in some markets, and if it's priced correctly, then we try to benefit from these, just like price of oil higher because of Russia being in some turmoil. So that helped us again with our call on the Canadian stock market. But other than that, I'd say pretty limited time on geopolitical issues.
Thank you very much. I guess I'll close it off, Russ. Sebastian, thank you so much. This, like Russ mentioned, this is our 15th annual. I listened to our 14th annual last night, and I did say in that we'd be up in Crown Isle doing this in person, but I will say that next year we'll be doing the 16th annual up in a boardroom the main room in Crown Isle. Investing other people's money is hard. It's very hard, especially in today's times. And we've been doing it for a long time, and it's nice to have the partners we do with IA Financial. And you can see that in this presentation. Before I close out, I wanted to wish Rudy a happy 50th birthday. He turned 50 on Saturday. I've known Rudy for 27 years. Russ and I and Rudy started on House Street. So now we're all senior advisors, I guess, over 50, and we're still love and have a lot of passion for this business. Over 80 years of investment experience with the three of us. And these type of events is all about education and motivation. So thank you for the 15th annual, everybody. You change your mindset, you change your behavior, which will change your results. Thank you.